Hello and welcome to Chapter 10, Standard Costs and Overhead Analysis. In this chapter, we are going to be looking at 3 different learning objectives. First, we're going to talk about what exactly are standards for direct materials and direct labor. Then we're going to calculate the direct materials price and quantity variance and discuss their significance. Then, in our last learning objective, we're going to compute the direct labor rate and efficiency variance and explain it. So effectively, number 1 is like a big overall, hey, what are these variances? Why are we looking at standards now versus budgets, which we looked at in chapter 9? How are they same, how are they different? And then we'll do a deep dive into the materials aspect. And then same but different for a deep dive into direct labor. So you'll notice some similarities. We talk about labor rate, whereas with direct materials, we talk about price. Again, same but different. And then here we look at quantity variance, and here we look at efficiency. But both of them are effectively like, this is quantity, just talking about how much we use in different ways. So just because we can't really call labor price or efficiency or quantity, because it's like quantity of hours, because we're talking about humans. Like this is effectively how much are humans working. So we do have a little bit of different wording. However, I will tell you that if you really take some time and understand first learning objective number 1, how is this working overall? And then you kind of let yourself like work through, okay, this is kind of weird. Why are we doing this with direct materials? Giving it some time to sink in. And then going to learning objective number 3, oh, like that's how we do this with labor. It's just like materials price, like the rate. And oh yeah, no, this efficiency is just like the quantity of materials we use, except now it's the quantity of hours that our labor is using. So anyways, just want to give you that overview. Let us get right into learning objective number 1. The overview, explaining how direct materials standards and direct labor standards are set. So first, a visual. When we look at setting standards for our direct materials, we talk about the following. First, a standard price per unit. So what does it typically cost us? What's the final delivered cost of materials, net of any discounts, shipping, receiving, and other such costs. So grounded, what is this going to cost us? And then standard quantity per unit. How much of material is required for each unit, and this includes, unavoidable waste, normal spoilage, and other normal inefficiencies. Because just because, it could take, 2 inches by 3 feet of wood to make a ski, like say that's how big the ski is, or plastic, or whatever the heck goes into skis. Apologies, I do not like winter sports. I like it for other people, just not kind of my jam. So just say you could make, a ski out of a 3-inch by 4-foot, 3-foot piece of wood. You'd likely need a lot more because you gotta sand it down, you gotta cut it down, you might have to do some trims, you might like have an oopsies. So you want to definitely start with a little bit more and sand it down or shape it to your desired effect. So that's why we talk about how much of this material is required to go into it. Right, and that's our standard. So let's talk a little bit more about this. For direct labor, so again, it's going to be same but different. We're going to have a standard rate per hour. That includes how much an hour of employee time typically takes, including all the things. So employment insurance, employee benefits, other labor costs. Is there, a typical amount of overtime that may be used in a month? That's part of our standard rate. And again, what is normal, right? What is standard? We'll talk a little bit on how to set this in a bit, but first I wanted to bring you in and show you kind of what we're doing, and then I'll talk about why we're doing it. Okay, so then same but different for labor as we looked at materials. Standard hours per unit. So how long does it typically take them to sand the skis, cut the skis, do the ski thing? So that's how much it's going to cost us in labor. This is how much time it typically spends. So just because, you could do a ski in an hour, maybe every 5th ski, there's an oopsies that needs a little bit more time. So we need to include an allowance for those normal inefficiencies, because people are not robots, and even robots are not robots, right? Like, stuff is going to go wrong. We need to account for this. This is not the ideal circumstance. This is like what could really happen. Okay. So, reason why we're doing this is to first set our expectations using standard prices and standard efficiencies and standard quantities and standard rates. And then, so we set that, and then we kind of go into our circle. So we first prepare our standards and prepare that standard cost performance report. Then we have our actuals that come in. We analyze those variances. We identify questions. We source those out to the responsible managers. We receive explanations from them. And then we do corrective actions when necessary. And then we set our standards for the next period, and so on and so forth. So for example, say we are like, yep, no, typical ski takes an hour and 15 minutes of labor time to make, including some inefficiencies, including some whoopsies that need to be fixed. And then it comes in at, an hour and a half. We're gonna go investigate that. Like, hey, what the heck? We accounted for an hour 15. You came in at an hour and a half, on average, times by, 10,000 skis this month. Like, this is big money. What the heck went on? And then we find out that, oh, hey, like 2 of our best employees just quit, and we had to replace them, maybe, and they're not doing so good. Cool. Okay. Do they need more training, or do we need new employees, or a little bit of both? Like, what is going on here? Or maybe it's like, well, we also look at our other variance, the rate, and because we saved a lot of money on them, we had these 20-year-long employees, but we got like cheaper people, or who knows, or maybe they required less overtime, who knows, the rate is cheaper. So overall, we're actually saving money. So maybe we just say, cool, let's use some of that money that we're saving and train them up a little bit. Or maybe we say, cool, now the standard rate, quantity used for hours is going to be an hour and a half. And then we just kind of go for it. We're happy that we have these cheaper people, but they just screw up a little bit more, need more fixing, and we adjust our standards going forward. So it really just depends. But that's why it's not good enough for us to just look at, hey, are we better than we thought, or are we worse than we thought? We really need to dig in. All right, so let's talk about this using some specific terms. Deviations from standards are deemed significant, and these are brought to the attention of management. And this practice is known as management by exception. Setting price and quantity standards is designed to combine the expertise of everyone who is responsible for purchasing and using the inputs. This includes accountants, engineers, purchasing agents, and production managers. There are the ideal standards that can only be attained under the best circumstances, and this requires employees to work at 100% peak efficiency at all times. Conversely, there are practical standards. These are tight but attainable. They require reasonable, although highly efficient efforts by the average employee. So those are the standards, the practical standards that we will be using. Okay, so let's take an example of what a standard cost card could look like. So this might be for a product. Sure, let's call it skis. Let's see how long this ski analogy can go for. Those of you who are like, I like to snowboard. Well, I don't like either. so here we go. I shouldn't say I don't like either. It's just, people, it's cold. It's really cold. And it likely requires a lot of money. So unless you really like it, I find it's hard to spend that much money on that much cold. I digress. Okay. So standards and budgets are very similar, but here's why they're different. A budget is a set for total costs, whereas a standard is a per unit cost. A standard, however, could be viewed as a budgeted cost for 1 unit of product. Okay. So standard cost per unit. This might be referred to as the budget cost for 1 unit. Cool. Price and quantity standards are determined separately for two reasons, and it comes down to responsibilities. So for example, the purchasing manager is responsible for raw material purchase prices, and the production manager is responsible for the quantity of raw materials used. The buying and using activities occur at different times. Raw material purchases may be held in inventory for a period of time before being required to be used in production. It comes back to who is responsible, who can actually fix it. If we go back to the previous slide, you know, so we can figure out what went wrong, why did it go wrong, and the person responsible can take corrective actions when necessary, and then we do this all over again. Okay, oops, sorry, forward. All right, so when looking at variances, in order to figure out who's responsible, what's going on, because all of this standard costs lead to variances. What's the difference between what actually happened and what our standards were? So because this all happens because we're unlikely to set the standards the same as what actually incurred, right? Standards are set before it actually happens. It's very unlikely we're going to guess perfectly correct. Okay. So if you look back and forward, this is same, but different. So we have a price variance for materials. We have a price difference for, oh my gosh. We have a price difference for materials and a price difference for labor. And if you wanted to look, we also have it for variable overhead. However, that's not what we're going to be looking at in this chapter. And then we have a quantity variance. How much materials did we use? How much labor did we use? All right, and again, so same but different. Materials price, labor rate, materials quantity, labor efficiency, but similar buckets. So put another way, we are going to be looking at this model for variance analysis, and this model will actually drive our equations. So if you understand how this model works, this will actually be driving the equation. So one can be built from the other and vice versa. So the actual quantity, you'll see right here. So first, if you zoom out, you'll notice that this is what actually happened. This is what we guessed would have happened, the standard quantity times standard price. And then in the middle, we're like, cool, if we knew what the actual quantity that we're gonna incur was, and then what's our standard price? And then that helps us figure out, like, was it the purchasing managers, paying too much? Was it the production manager using too much, or vice versa? Did the purchasing manager get a great deal? Did the production manager, do better on their end? So we start off with AQ, actual quantity times actual price on one side, on the other, standard quantity times standard price, and in the middle, what quantity would we have, what did we actually use times by our standard price, and then we minus them to find the differences. The difference between what actually happened and what our standard price at the actual quantity was, our AQ times SP, is our price variance. So this minus this gives us our price variance. Similarly, our standard quantity and standard price minus from our actual quantity times standard price, that gives us our quantity variance. And then price variance plus quantity variance, you only have two types of variance. Did we spend too much or spend too little? I guess good news, bad news for price, good news, bad news for how much we used. Those variances together gives us the total flexible budget. And that is the difference between what actually happened minus what we thought was going to happen. So these two together gives us our total overall budget. All right. So now this helps, you'll see below here is our graph analysis, kind of our, I don't know what we even call it, like our figure perhaps, kind of like our visual, like, hey, what's this budget thing? And then up here, if you notice, we're going to take the red AQ times AP, actual quantity times actual price, and boom, pop it up there. And then we're going to minus it from our AQ times SP, and that gives us our formula for price variance. So right up here, this is our price variance formula. And similarly, when we have AQ times SP minus SQ times SP, that is our quantity variance. So our price variance plus our quantity variance gives us our total flexible budget. And here's the formula that's derived from our conceptual model in order to get our variances. You can use either. In fact, I often build the, each year that I teach this, each time that I see this in CPA or at Dal, I like to go through this visual because I can build all of this. Because on one side, I'm like, cool, what did actually happen? On the other side, what did I think was going to happen? And in the middle, if I actually knew how much I was going to use at my budgeted standard price per unit, that's going to be my middle. And then I can kind of build out this variance accordingly. Because if you then look at these formulas up here, if you take out the duplicate, so if you take out AQ from both sides using some algebra, you would actually have AQ times AP minus SP. And if you're looking at the actual minus budgeted, that's a price difference. You're looking at the actual minus budget equals price. And if you do the same thing over here, you know, look at the duplicate, you have SP and SP. Okay, algebra, we're gonna take that out. That leaves us with SP bracket AQ minus SQ. Cool. That what we thought was gonna happen, sorry, let's see. SP, AQ minus SQ, what actually quantity did we think we were going to use minus what standard quantity, what did we actually use as quantity minus what we thought we were going to use, and that's a quantity difference, and that's therefore a quantity variance. Cool. So again, I like to build this conceptually. I like to pull it out, do some algebra, get my formulas, and there you go. Okay, people. This is exciting. If this was a little bit confusing, oh my gosh, yes. If you intuitively get this, kudos. You are miles ahead of where I was at when I was doing this for the first time. So if this is a little bit confusing, what I would ask for you to do is stop the video, because this is our last slide, and take some time. Go for a walk, go get a hot chocolate, like do your thing. And then come back, maybe you rewatch it, maybe you take some notes. Hopefully you've already done the mini lecture pre-work, and you know, learning is repeated exposure to same or similar topics. Come through, watch it again, beef up your notes, see if you can build out the formula on your own. And when you're ready to do some examples, we're gonna apply this in the next learning objective to our materials. And we'll walk through an example together. Then you'll have a chance for you to kind of test yourself going through. And then we'll do the same but different for the labor, labor in the third learning objective. So thank you so much. It's great to see you. It's great to talk to you. People, very, very close. Okay. Most of our videos for the next, we have 3 chapters. Most of them have like 3, I think 3, maybe 4 videos. We are getting there. So stay motivated. March is hard, but I know you can do that. Talk soon.